next panel. This is in regards to the climate economy and more than energy investments. And basically what we're going to talk about is how we're going to keep the green economy growing. Dipender will be leading us in our conversation, and we look forward to this.
Maybe we can pick up right where I left off. I didn't cover a few slides that I had around some other opportunities like the 20% wind opportunity, especially since we're right in the neighborhood of a bunch of states that have an amazing wind resource. Didn't talk about the investment environment, the amount of money that is now coming into the space, the tax credits and policies. So we'll transition to that part of the conversation. And before I do that, I'd just like to request the other three panelists here to introduce themselves and share with us what their passion is about this space. Do you want to start?
I'm happy to go first. My name is Eckhardt. I'm with Seminole Equity Partners, and my firm focuses on investing tax equity into solar and wind projects across the country. We also provide construction and permanent debt. We've been doing this since about 2008 when we started, and it's been a great run for us, and we're a one-stop shop, which basically means developers can come to us and get all their finance needs met under one roof.
Hi, I'm Garvin Jabusch. I'm the Chief Investment Officer and a founder at Green Alpha Advisors. We're right down the road here in Boulder, Colorado. We are investment managers dealing in public equities. We run 5 strategies, including 1 mutual fund, all centered around this idea of modeling and then building portfolios that reflect an idea of what an indefinitely sustainable economy could look like. So as opposed to doing what most portfolio managers do today, which is model portfolios based on the incumbent economy, we take a look ahead, 5, 10 years, much like Tony Seba was saying yesterday, and then build portfolios that look like that economy as opposed to the one that we're living in today. So that was our idea, just entirely focused on sustainability.
Great. My name is Casey Verbeck. I also live right down the road here in Boulder, Colorado. I'm the director for Veris Wealth Partners. We're a private wealth management group. It's a national firm with offices in San Francisco, New York, Portsmouth, New Hampshire, and Boulder. What makes us unique in the market is that our investment thesis is 100% devoted towards impact investing. We represent just north of 200 families, foundations, and individuals. That equates to just under $1 billion in assets under management. So we invest across all asset classes in a variety of different thematic areas. So we'll talk about that more here today.
Excellent. So maybe, Rod, you can kick off by saying, by telling us, what do you think the environment looks like from a policy point of view, from a health of investability point of view, and what needs to happen here in the near future?
Sure. A couple of things. My team, we have all been working in big banks most of our lives, and we did mostly real estate investing, and we moved into renewables in 2008. And we found it to be a much better investment, really. It was a safer investment, more predictable. The returns were actually better in most instances. And the policy was right. There's something called the investment tax credit. It's under Section 48 of the code for people who love to go through the code. I might be the only one in here that does that. Anyway, that basically allows corporations to use this tax credit to offset taxable income that is generated in other parts of their business. And as long as you have that tax credit in place, there's a community of corporates, basically. There are some folks, high net worths, that can take advantage of this credit, but mostly it's widely held, publicly traded companies. They'll invest in these deals. That tax credit has been very helpful. It is set to expire at the end of 2016. That tax credit capital that goes into the transaction represents typically anywhere from 30 to 40% of the overall capital stack. So if that goes away, and this tax credit is allowed to expire, there'll be a hole there that we'll have to find a way to fill, getting capital in other ways. There's discussions on trying to extend that tax credit. We'll see if that's successful. A year ago, I would have said it was impossible to get that extended. Now I will say it, there might be a chance to get it through, but it won't be until next year. And so folks are trying to come up more with debt programs and various ownership models that you might be familiar with, and yield cos and further discussions on trying to get MLPs and REITs involved in this space to lower the cost of financing capital to keep things rolling. But most projections that we see demonstrate if the ITC goes away, you'll see a slowdown on the solar front. Wind has been fighting for an extension of their PTC for a while, and the wind folks that have been on these panels have described the need for that it hurts them. And that's the big fight right now, is to extend those tax credits, also extend access to various ownership structures that are helpful, and we'll see where it all falls down. Point is if none of these things are extended, we'll still be growing. It just won't be as rapidly.
Casey, you want to talk a little bit about your thoughts on this transition and what?
Yeah, we've had a huge discovery. When the firm launched in 2007, we knew that our clients came to us that were values aligned, and all of them were philanthropists. But just recently, we did a sample amongst all of our clients about what they want to see next. And in addition to our staff and our research team looking at the market. And what we realize is it's moving into this whole portfolio activation discussion where folks not only want to activate their portfolio across all asset classes related to the thematic areas, but they really want to go much, much deeper based on the thematic areas of interest. What came out of that were bubbled three specific thematic areas firm-wide. And this is a sample set that came from age groups ranging 25 to 55 primarily. And this conscious group was heavily focused on sustainable food and ag and domestic needs and also emerging market needs. Second to that, the sample also came back saying environmental investing across the board, anything to mitigate risk against climate change and to start turning the needle there. So that was a broader discussion, which as investors trying to meet that need, we can get into more details. And then the third one was community wealth building. So looking at the risks that climate change brings to communities and how do we strengthen those communities to be resilient for the long term. So we've been looking through those three lenses, and the firm now has just passed over 100 different investable products across the board of all asset classes. It's a lot of work. Product innovation is heavily needed, specifically domestically. One of the ways we're tackling that issue, and I don't want to get too deeply into it because we're going to talk about our Divest Invest panel today, but the muni bond market's come a long way. So we have several managers that are focused on retrofitting of buildings within communities our clients are based. They like to see that. And also installation of renewable energy projects within place-based opportunities for clients. So this negative screening is moving way into positive screening, proactive approaches and strategies across all asset classes.
I think you brought up a good point about the Divest Invest, and I know there's a panel around that which will have a lot of discussion. But one thing we have to make sure is that people don't just divest, because that's just, it's a good thing for people to do, and especially people that really feel passionately about it. But almost more important is what are people investing in, because what's more important is what are the new sort of solutions, and how do we get some of the solutions we talked about earlier this morning out there at scale, as opposed to people just divest and then sit on the sidelines and say there's nothing for them to invest into something new. You want to share?
Sure, I'd be happy to, and thanks for the tee up, Dipender, because the way we run our portfolios at Green Alpha is if it isn't a solution, it doesn't belong in the portfolio. Our investment philosophy is simple. No portfolio has any business investing in the causes of our great systemic risks, those primarily being the worst outcomes of climate change and resource scarcity, notably around water and phosphorus. And everyone, as a corollary to what you're saying, should be invested in the solutions to those things, what we call the next economy analogs to the legacy economy functions that got us in trouble in the first place. So in thinking about what I do day to day in my job, in many ways my job is a lot easier than Casey's, because I get to think about what this next economy is going to look like, and then focus on the pure research and portfolio construction around building a mutual fund and some other portfolios that look like that future, right? And those tend to be technology leveraged equity growth portfolios. And then guys like Casey get to decide how appropriate those are for their clients' portfolios, and I get to just keep my head down and focus on modeling that. And so with respect to being focused entirely on solutions and thinking about where the investments are likely to be best, we reject the idea that you have to have traditional sector allocations the way that you might see in sort of the Morningstar style box. You know, if you pick a large core fund, you're required to have X% each of the legacy economy sectors. We identified a problem with that, and the reason we founded Green Alpha, in fact, is because, as you point out, Casey, negative screening isn't really getting the job done. We wanted to just throw that out and start over with a new model. And secondly, because you end up being sort of stuck with a lot of the constituents of those old-timey, I mean, they're still incumbent, but those hopefully increasingly fading legacy benchmarks. So rather than do sector allocation, I think about doing it in terms of risk factor allocation. What are the big risks confronting the global economy and civilization, and what is scientific consensus around the things likely to help get us out of those problems? Thinking about it that way, of course, I think about things like solar, like storage, like zero emissions transportation. I was completely excited yesterday when Tony Seba threw up early. He put up 15 things that he likes to look at, and then he narrowed down to 4 to talk about in detail. But of all those 15 things, I thought, that's awesome because I have exposure to all 15 of those things in my portfolios right now. And that made me happy that I'm on the same page as a big brain thinking about the future. But with respect to the ITC, for example, I think that if SIBA and other thinkers like Deutsche Bank are even half right, you know, solar is going to be 10, 20, 30% of the global energy mix by 2030. Up from 1% today. It's pretty clear where the growth is and where you want to place your chips as an investment manager. If we have a slowdown in 2017 that causes share prices to pull back as a result, that's just a great opportunity to buy a bunch more because we're still going to be at that big percent of the energy mix by 2025, 2030. So answering 2 or 3 of your questions at once there. Sorry if I went on a little bit long.
No, I'd just like to add that you referred to a couple of studies. A few months back, Deutsche Bank, in fact, declared they analyzed and concluded that there was just over 70% of markets around the world at where solar now, unsubsidized solar, was beginning to make sense and had reached parity. 70%. And, you know, 10 years ago, people were talking about how almost no region in the world it made any sense and it had to be heavily subsidized. So that growth of filling that 70% is going to require a lot of capital. And as you all know, the characteristic of that change is upfront capital as opposed to capital along the way. And again, that's a challenge and a great opportunity for people who want to invest in that space.
If you guys are interested in a deep dive on solar, you should read that thing. It's 175 pages long, but Deutsche Bank didn't mess around. It's very thorough, and it really breaks down a lot of these issues.
That's right. Rod, anything else you would like to add to that?
Well, I'd basically say there's an awful lot of work going on in Washington and in state governments right now on how to create some sort of energy policy that will continue this trend. It is not a very friendly discussion a lot of the time, as you might expect, but there has been some movement. We talked to both sides of the aisle, and we actually are getting good questions from a lot of people that weren't interested before in how to encourage this growth to continue. Traditionally in America, we've used our tax code as a policy weapon to try and get certain groups to do certain things, and corporate America has a tax code that's built very well for them, and tax credits are something that they're used to and that they like to implement. So whether or not tax credits are a piece of this going forward is up for discussion. I think that it will be for sure through the end of 2016, but I also am cautiously optimistic that there'll be some sort of extension, similar to what you've seen with the PTC, where it expires and then they retroactively activate it again. So it's a to be continued type discussion, and vote for the right people.
To add to Rod's point about what's happening in our country here in the U.S., I'll shed some light on what's happening outside the U.S. There's a huge part of the world, you saw some of the numbers from my slide, right? A couple of billion people with no access to electricity or energy that really need it, and are paying top dollar today for the dirtier substitute, whether it's coal or kerosene or diesel. I've met with maybe half a dozen heads of state over the last year, and the one common theme that I get from a lot of these people is the energy security aspect of it and what pressure energy has on their economies. And so most of these, or rather all of these countries that I've met with, none of them are blessed with fossil fuels as some of the rest of the world is. And so for them, all their energy consumption means a huge amount of precious foreign exchange for them going abroad, going to the various oil-producing countries today, and then going to the same countries in the future. And what they see, what clicks in their mind, is really an opportunity to manufacture their own energy and keep the jobs inside their own countries, have this sort of balanced progression of build your own energy, create those three jobs per dollar spent, and cut down your foreign account deficits. And in some countries, this can mean as much as their entire national budget. I was in Rwanda 3 weeks ago, small country, but an interesting example. And the finance minister got up and he said, I have two budgets. I have the national budget and I have my diesel budget. And he says they're about the same. And we thought he was joking, and then he actually showed us the numbers. And he literally said, I can handle the national budget, but I can't handle the diesel budget. There's just no way for me to justify, because my whole country runs on diesel. So the opportunity, again, is huge as you go out into the rest of the world. And there, it isn't about debates in Washington about who gets subsidized where, and are we trying to subsidize the coal industry, or are we trying to subsidize the gas industry, or are we trying to subsidize the solar industry? They're just saying, how do we turn on the lights? And that opportunity is massive.
Well, we think a lot about how to build the appetite, right? And even within our own client base. And a lot of that comes back to portfolio construction. How do you start to look at solutions based on specific asset classes? And one of the things we're asking our managers is do a better job in telling their story, how they fit within certain asset classes specifically. And then second, there's a massive need for impact reporting. Because at the end of the day, as folks start to make more and more investments in this domain, stories are great, don't get me wrong, but we need to start looking at metrics. So we've spent the last year and a half in building out an impact report overlay for all of our portfolios. But the only way that's going to happen is if the managers start to buy into that process as well. So two things I just challenge us as a board is to think about how to better speak to investors, one, and two, how to better report to investors. So I don't know if you guys have any additional insights on what you're doing from a reporting perspective, but I would love to hear more.
Well, first of all, if I can, thanks for doing that work on getting additional transparency and ways for clients to think about it. Yeah. Because as the world is today, it's really tough for people to know exactly what they own and or what impact those things have. Yeah. When I go give talks at universities or where have you, the same question comes up every time. Mm-hmm. How do I disambiguate meaningful ESG from non-meaningful ESG? How do I know what's even in there? And unfortunately, the only answer I can really truthfully give right now, except for, I guess, clients of Veris who get to use your awesome tools, is you just have to do the work yourself right now. Mm-hmm. There's no star ranking. You have to look at the actual constituents of your portfolios and decide if you think that's where the future is going. If that's, because look, at the end of the day, all a portfolio is a vision for the future. And you need to look at the holdings of your mutual fund or whatever else you own and decide on two levels if you think, one, if that's where the future is going in terms of the growth sectors, what is the future economy going to look like? And therefore, do you think you've got a decent chance at competitive returns because those are going to be gaining market share from their legacy economy counterparts? So, for example, solar gaining market share from coal, to take a very low-hanging example, but they're all across all sub-industries. And then secondly, is that the economy you want to see in the world? And really, right now, that's the only way to do it. So more and more tools like what Veris is developing is very important to help people get their minds around it, because not everyone has the time or the wherewithal or the expertise to examine every one of their holdings. If they were going to do that, they should just be a fund manager, you know?
Yeah, and we're trying to meet the need, right? So actually the next gen is really pushing this agenda of saying, you know, I'm in, but I want to understand, right? I really want to understand the social environmental outcomes of my portfolio. So I think as we think forward, just to be more fundamental in our process of thinking, is collaborating on how we're going to start sharing data. And it is a process. It's not going to be solved overnight, and we realize that. But if we can just start making even small steps to show, you know, 3, 4, 5 inputs of metrics that are being, you know, staged over a period of time, would help move a lot more capital, even for those who are interested.
That's been an issue for us. I mean, we serve a different constituency than you, but that's a problem for us too, is the reporting and information that you're getting and exactly what does it mean. And some sort of standardization of material is important. And there's a lot of folks trying to work on that and create various software programs. And we're making progress, but that's interesting for me to hear you talk about that, because we're dealing with that as well.
Yeah.
Because it's been a bit of a barrier for some
It
folks.
is.
They didn't want to get in because they're not sure.
Exactly.
It's a growing barrier for us.
I don't know if Sally's in the room or not. I'm assuming she hasn't made it yet. Maybe we can break the rules here a bit and open up for questions from the audience if there are people in the audience that are interested. I saw a hand go up there on the left. Sorry to do this to you folks, but if you have a roving mic, could we get one
We can probably hear you.
to the left? Okay.
Thank you. Bob Goff, Intertribal Council on Utility Policy. 2001, I went down to American Samoa as part of a delegation of the U.S. Department of Energy. I was there for wind, there was solar, geothermal, biomass, and tidal renewable energy experts. The island was concerned that should war break out in the Middle East, as it did, their entire economy was dependent upon the 3 diesel gensets and the next tanker. And most of the islands in the Pacific are in that same situation. As they looked to see that each of them could go totally renewable, 100% renewable, they saw that the cost of their food, which now is their 80 to 90% import reliant, would skyrocket, because it's the oil transport that subsidizes the delivery of food to those islands. So as soon as they go 100% renewables, they can no longer afford to eat. So now they're looking at food forests, but it's very hard to find investment in food forestry and food resources at that local level, rather than, you know, big plantations and that kind of investment in agriculture. So I just wanted to put that question to you. Many small economies could go 100% renewable if they could also work around that next angle of providing for self-sufficiency. Thank you.
Anybody want to take that?
Sounds like a project finance question.
I don't know. That's we actually look at a lot of projects in U.S. Virgin Islands, Guam, and we're making some inroads. My firm has not been able to make an investment yet, but there are a couple that have done so. I'm unaware of the example that you just described. I'm not sure if, Casey, you would have some better insight into that?
Yeah, you know, so as I talked about, asset classes have certain entry points into certain issue areas. There's 3 funds that come to mind that we have on our platform, 2 specifically, which are promissory note structures that are specific to meeting agricultural demands in emerging developing markets. Those models are based on long-term thinking, so you're earning 2.5% on an annualized basis over 7 years. But they're coming in and working with the local villages to implement new ways of doing agriculture around biodiversity reserves, also towards climate change risk. But at the same time, they're providing technical assistance programs to help those local villages to also obviously create economic value as well. So I can share more after this conversation as well.
There was a question over here in the center.
John.
John Powers, Alliance for Sustainable Colorado. Dipender, you mentioned earlier about filling in the gap of the grid. And we've got basically a structure that is centralized in power distribution versus decentralized, and you get into third world countries, this example of food and energy being sort of parallel and centralized, coming the fuel transport versus decentralized, making yourself independent. Please clarify what you meant by filling in the gaps of the grid. Are you thinking of filling in the gaps in the grid through extending transmission lines, or filling in gaps in the grid which could be decentralized and providing services where they don't currently exist?
Sure. So I think that depends on the geography, but I think that part the numbers I was showing was the rest of the world, which is the 2.5 billion that don't have access. So a common characteristic in many of those is that they have built some grid infrastructure, clearly not reaching all their constituents. India, roughly, there's about 600,000 villages, locations that just don't have a grid anywhere nearby, within 50 miles of that location. But there is a fair amount of grid in the urban areas, but there's a huge shortfall of energy on those grids itself. So the grids are intermittent. They don't perform well. There are many areas where they get electricity for 2-3 hours a day, maybe 8 hours a day. And so building a commercial economy is very hard when you can't predict it. So everybody goes diesel. So that's the gap that I was referring to, which is today all those shortfalls in the grid, and depending on whose numbers you look at, the estimate is, and I have a chart on that. We can throw that up. It's roughly 200 gigawatts or so in the subcontinent, and then maybe the same number in Africa. In places like Kenya and Rwanda that we just talked about, the grid only reaches about 30% of their population. So there's filling the grid to get the electrons on the grid that already exists, and that's getting energy to 30% of the people. And then there's building distributed energy or building new grid to get to the remaining 70% of those populations. And there, I would say, the consensus and all the data and all the trends that are happening is, rather than expand the grid, is to just move to a distributed energy model. Because with all the technologies that we have now developed, and a lot of them past the tipping point, whether it's solar or solar plus storage, or fuel cells, or solar plus storage plus diesel, depending on your flavor, going to a distributed energy model is much cheaper than trying to expand the grid to some of these areas, and then waiting the 10-15 years that it's going to take to do that, and then fill that grid with some kind of a centralized generation. I think the model there is going to be very similar to that of telephony for most of these countries. I was telling this story last night to Sally. I grew up in India till I was a teenager, and up till at that time, in the 70s and 80s, it used to take about 12 years to get a telephone line after you ordered it. So the next time you're upset at AT&T, think of that. You call the phone company and they say, great, we got your order, we'll see you in 12 years. And in 70 years of telephony for 1 billion people, they installed a whopping 45 million phone lines for 1 billion people. 15 years ago, when the whole mobile telephony movement started, which had nothing to do with building the infrastructure, they started adding at its peak 20 million wireless phones a month.
Wow.
So in 2 months, they would install more wireless phones than they did of telephones in the entire history of telephony. And today they're approaching, it's just under 1 billion cell phones just in that one country alone. And the same story is repeated in Africa, and the price points are a fraction of what the landlines used to be. Uptimes are phenomenal. I think there's a real parallel here between the way the world went to mobile telephony to the way I think the world will move towards distributed generation versus expanding the grid.
Yeah, just leapfrog right over the traditional hub and spoke. It not only makes sense in the developing world, but right here in the developed world. I was reflecting the other day with a colleague that it's almost crazy that we got as far as we did with an electricity system that can't, as a commodity, it's about the only commodity we know of where there's no retained inventory. There's just none. So we just run base load 24/7, whether anyone's plugging into it or not, in order to keep the economy going. And yet there's no backup inventory. There's starting to be Powerwall and other things, matters of storage. But right here in the developed world, we're going to see a far more efficient economy as a result of distributed grid and storage. In this case, the developing world is going to lead us there.
Yes. And by the way, there's an irony in that story too, which is that the mobile telephone industry didn't exist 15 years ago. And because there is very poor grid around that subcontinent, the mobile telephony industry now has 400,000 cell towers to bring this distributed telephony to the population. Those cell towers, in turn, are now powered by diesel primarily, and the mobile telephone business has become the largest consumer of diesel, 6 billion liters of diesel a year. And this industry didn't exist 15 years ago. So there's an irony here that they solved the infrastructure problem and won, and now they've laid bare the gap in the infrastructure problem on energy. And what you're seeing is a rush and a pretty large opportunity to go power these cell towers with solar and batteries and eliminate that diesel. And then that in turn has a very nice second order effect that now in the most remote parts of the region, those 650,000 villages that are not electrified, you have points of electricity which are there because of an anchor client. And those points of energy can now proliferate into the adjacent communities and bring energy faster than they could, because you have an anchor client that had a reason to bring those. So it's phenomenal the speed with which this is all happening. So, sorry, there was another question back there.
Good morning, DC Cordova. You know, I have been in the education business of business people for the last 36 years. And when I started working with Wang Ming about 8 years ago, very traditional investors in oil, coal, and real estate began to ask me the question, why should I move over? Now, I'm a newbie at all of this, and I wanted to hear from you the top 3 reasons that I can give many of my very successful graduates why they should start investing in renewable energy. And just simple, because it's hard for me to explain it, and I really want to hear it from you. Thank you.
Who wants to take that?
I'll take a start.
No, go for it.
And then I'm sure everyone will want to pile on because there's a lot to say there. But I think the first reason, first of all, thanks, Ms. Cordova. That's a great question. First, I think it's clear from, I won't recite any stats because between Dipender and Tony Seba and everybody else at the conference, we've seen that it's clear that the growth phase of fossil fuels in this world is pretty well over, at least the rapid growth phase. And thinking about returns of growth equity investing, it's just not where you want to be invested on pure economic grounds. Secondly, for those who still have a lot of fossil fuel holdings, and I do hear this from a lot of Green Alpha's clients, is we love your fossil fuel portfolio for a minority investment, something like 5%, as a hedge against our fossil fuel investments. So that's a second key reason. What about you, Casey?
Well, I think you're starting to hit on the preservation versus extraction piece. You know, we can only extract so much of our resources, and preservation is where we need to put the emphasis going forward. And there's a lot of data around the importance of that, which we'll get into our next panel, referred to as natural capital. So I just encourage people to Google that term and look at the importance from the preservation perspective.
Yeah, I'll add just one quick thing. Most of the portfolio managers in this world use Markowitz's old modern portfolio theory, which prescribes that we when we build a model that we look back 10 years to see how that would have behaved in different market cycles and different environments and try to find the best compromise between risk and return. And using that, if you look back 10 and 20 years, fossil fuels look like a fantastic source of risk-adjusted returns. And I think that it's the fact that everyone is really still running their portfolios based on that theory that it's so very hard for so many people to divest, because fossil fuels historically are just this terrific source of risk-adjusted returns. But what we're learning here is that time is over. They're no longer such a great source of risk-adjusted returns. And it's time for folks to, instead of drawing conclusions based on what has happened, recognize that the pace of innovation in this world is growing geometrically and start making your investment decisions on the basis of what's about to happen.
Anything to add, Rob?
In my world, the investors are looking for returns. That's primarily why they're investing through us. That's actually a good thing. For a while there, a lot of people thought that the renewable space was a loser. And there are a lot of people out there who disagree with that now and have learned otherwise. So that's the primary motivation, but they're also motivated to a lesser extent by the fact that it's a good story. And corporates, of course, like to be good citizens when they can, and this helps them do that.
Yeah, so net innovation, good return, and the right thing to do. I don't know if there are any other questions, but one more and then I was going to wrap up with the panel.
Thank you. Thank you. I'm Joni Clark from AREDAY. I'm also a slow money practitioner. And I'm just wondering if we couldn't use the principles of slow money as a collaborative effort here at AREDAY and beyond. For when you're doing your projects, look for slow money projects which are focusing on those elements, as well as Bob was talking about food, the source of food, so that it's connected to energy. Because under the slow money model it is. And when you see that initiative in the ground where you're looking at project funding, that could be an advanced model or a hybrid where, oh, we'll put in some loan funds for that, or grants, but more likely loan in the model of slow money. Have some collaboration there, because that's taking advantage of the ground intelligence, what natural people want to be doing and what their skills and resources are. And it's always connected to food and energy. So I think there'd be a huge win for all of us to see a collaboration along those lines. I'm also a partner and investor in the poem. Manu Blackburn presented here earlier. She's the founder, the Palaces of Extraordinary Miracles, which are projects that have an extremely green environmental footprint and are built for health and healing. So as we work with our investors on this, it's using this to create living models for our environments, our housing, our recreation. So I'd love to see some collaboration and see if you might think that's possible.
Casey.
Well, absolutely. I mean, we're food security and the intersection. If you think about food security across the board, it's has many layers and complexities to it that we all have to address. So, as I mentioned earlier, it's a major area of focus for us as a firm and client-wise. So, this is my first AREDAY conference, but I'm sure there's synergies in the room that would like to explore that. And Veris specifically is already committed to that dialogue and very close with Woody Tash and Travis and team.
Great, so maybe a good time to wrap up as we're getting close here. What I'd like to do is maybe just go around the panel and share a thought of, where do you see this going in the future? Any predictions that you have, and maybe, with apologies to Chris Matthews, tell me something I don't know.
Go ahead, Garvin.
Yeah, that's a hard one. It will sound very redundant here and fairly boring, but I mean, it is an exciting future in the renewable space. I know one area or two areas that I'm particularly focused on and excited on. Now, while I've traditionally been investing in solar and wind, I'm extremely focused on microgrids and battery storage. That a lot of folks are. Those are two areas that we and my team view as great opportunities in the near future.
Very good.
I think from a very high-level perspective, we either think that the global economy can get itself onto an indefinitely sustainable and hopefully even regenerative footing, or we don't. And if we do think we can get to that economy, that it is time for us to start investing like it. Because as long as it is today, 90% of all assets are still invested in the legacy economy, then that's the economy that we're going to get. So we need to intentionally design where we think the global economy can be and really accelerate our efforts to get there, because time's running out.
For me, quickly, is focus on scale, so infrastructure. So how do you focus on digital distribution of renewable energy? And also, as it relates to solar, we're doing a lot of investments on installation needs to scale that in a more rapid environment. So I would just say look at those two areas currently from an investment perspective.
And I'll add to that, obviously, I come from the technology side and see everything that's happened on the computing side and communications and data. And I really see the same sort of speed and excitement now having come into this new energy economy for many years. And I think many of us have gotten so used to the naysayers telling us, this stuff doesn't work, it's a waste of money, this is never going to happen. I think overnight, pretty much, in that scale, that story has changed. I rarely meet anybody now who says this is not for real and this is not the biggest opportunity in our lifetimes. And what makes it very, very exciting is that it is not only the biggest commercial opportunity of the lifetime, it is also one of the most impactful opportunities of our lifetime, where we can go fix something that desperately needs to be fixed. And I can pretty much predict that there will be several big companies, massive companies that you haven't even heard of, that'll get created here in the next 10 years. And we will see solar everywhere, and we're going to see electric vehicles everywhere. And I think that happens in the next few years, not the next decades. With that, thank you. Thank you to the panelists.